What's up, guys? Welcome to another episode of the Stock Bros Podcast.
Yep, so we're available on all major podcast platforms if you guys didn't know. And before we get started, don't forget to subscribe, like the video, leave any comments or suggestions. So, yep.
Also, use our link below for a free stock on Robinhood, or you can use the Acorn link and you get $5 invested.
All right, so let's get started. Today, we are talking about taxes, and this can seem like a scary topic, but it's really not. So first, we're going to go over what the term capital gains tax is. A capital gains tax in general is just when you have a stock and then you sell it, it's called capital gains tax. And you're not taxed on a stock until you sell it. So if you hold a stock for like 10 years straight, you won't pay any taxes on the actual stock until you sell it.
So you could pay taxes on dividends.
Yeah. Dividends you would get taxed on, but we're talking
we'll
about
cover that later.
Yeah. All right, so there's two types of capital gains taxes. There's long-term and then there's short-term. So for a short-term capital gains tax, so stocks that are bought and then sold in less than a year from when you bought it are subject to a short-term capital gains tax. And then this tax rate is just your ordinary income rate. So if you're taxed when you say you're a teacher or something, you get taxed at like 22% or something. And then you sell a stock in less than a year, that would be 22%. It would be the same as your income.
And I think one important thing to mention, which I've been asked about this on some of the forums, is if you put $1,000 in and you make $2,000, you only pay tax on $1,000 on your profit. So if you started with 1,000 and now you have 2,000 total, well, you made 1,000. So you pay tax on 1,000. You don't pay tax on your initial 1,000.
Yeah, I was
just
about to mention that too. Yeah, so you're only taxed on the profit basically.
Yeah.
So if you put $1,000 in and you make if you put $1,000 and you make $0, you're not taxed, and you sell your stock, you're not taxed on anything because your profit was zero.
So you're taxed after your initial investment. That's what you're taxed on.
Exactly. And then so long-term capital gains tax, this is really good, and a lot of really wealthy people take advantage of this. So if you hold a stock for more than a year and then you sell it, you'd be subject to a long-term capital gains tax. And what a long-term capital gains tax is you're not taxed at your ordinary income tax. You're taxed at these rates that the government made. So there's either 0%, 15%, or 20% is the most. So 0% is if you make $0 to $40,000. That's pretty damn good too.
Yeah,
you're not getting taxed at all. If you make $40,001 to $441,450, so basically $40,000 to $441,000, you're taxed at 15%. That's also pretty good considering if you make $440,000, you're only getting taxed 15%.
Yeah. You're normally going to pay like 37%.
Yeah, exactly. And then 441,000 or higher is only 20%, which is also ridiculous. If you make $10 million a year, you're putting most of that in your stocks afterwards, and that's how you're sort of making your profit. You're only going to be getting taxed at 20%, which is crazy.
This is why wealthy people invest, to save on taxes.
Exactly. Exactly. That's pretty much it for capital gains taxes. Those are the two types.
Yeah. So now we're going to cover dividend tax. So we covered dividends, what dividends are in our previous episodes. So you have a qualified dividend tax and a non-qualified or ordinary dividend tax. So to be qualified for a qualified dividend status, there's 3 requirements. It must be paid by a U.S. or a qualifying foreign company. Obviously, the government deems what's qualifying. Number 2, you're required to hold the stock 60 days prior to the dividend payment date, right? Or else you can't claim long-term qualified dividends. And then the third is you need to check the IRS dividend exclusion list. We looked into this. It's kind of murky. There's a lot of information that's contradicting out there. I wouldn't really worry about this one too much because you're going to get your tax form at the end of the year from your brokerage, and you'll know if it's qualified or not. So now non-qualified dividends or ordinary dividends. These are taxed at your normal income rate, and they're usually REITs, foreign companies, or if you don't hold the stock for 60 days, then you're going to have to pay the ordinary dividend tax until after the 60 days. So what's ordinary dividend tax? So the ordinary dividend tax brackets for 2020 right now are 10%, 12%, 22%, 24%, 32%, 35%, and 37%. So that's what you would pay on an ordinary dividends. So it's a really good deal to hold it for more than a year, for a normal stock.
No, no, that would actually be 60 days, not a year. If you have the dividend for more than 60 days, that's what you meant.
I just meant for an ordinary stock. Like if you just buy, if you just buy Apple and you sell it before the year is up, then you're going to need to pay your ordinary income tax bracket. So it's so smart to just hold it for a year and save so much money on taxes.
Yeah, exactly. So also I just want to mention how you get your tax form. So if you can request, well, your brokerage should send it to you. If they don't, you can request it, but they will only send it to you if you've made a profit of more than $10 in dividends, or $10 in dividends, or just a profit when you sell a stock. But you still, if you make under $10, you still have to pay taxes on that. They're just not going to send anything to you. It's the same thing with like interest in a bank account. If you make under $10, they're not required to send you any form, but you would still have to report it. Right.
Yeah. So we'll double check that number. We'll throw it up on the screen, but I believe that's right. $10.
Yeah.
But that wraps up today's episode. Don't forget to subscribe, leave a like, and comment below.
Yeah. Also, don't forget to start investing. Use our links in the video description below, like we mentioned in the beginning of the video. And then until next time, guys, thanks for listening.
Thanks.
All right. Perfect.
Okay.
That was pretty good.